when you are investing out of area, whether you are in the US or not, your boots on the ground, your management team, the people you can rely on to service you are very key members of your team and a very key element of your success.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me today, I'm excited to have Hadar Orkibi. Hadar, how are you doing today?
I'm doing great, Todd. It's great to be on the show. Thank you for having me.
Yeah, man. Well, I appreciate you coming on, and a little bit about Hadar. He started in real estate as an agent in Israel before immigrating to New Zealand in 2003. And he spent his first 3 years educating himself on trading, on trading real estate and working in the vineyards and orchards of Central Otago. Okay, New Zealand. So, and you have nearly 2 decades of full-time real estate experience and specialize in long distance investing. And before we jumped on here, we were talking about stuff in Tennessee and in Arkansas. And so you're buying in the US. You also have investments in New Zealand, it sounds like. And so you're kind of all over, which is crazy. And we're going to get into the details of how you invest in different areas of the world. People talk about different areas of the country, and you said, no, we're going to do the whole world. So that's pretty cool. Right now your focus is multifamily. You're doing some other stuff within, self-storage and mobile home parks. And you've done wholesaling, house flipping, subdivisions, new construction, joint ventures, commercial. You've done it all. So with that said, can you give our listeners a bit more about your background and then, what your main focus is today?
Okay, I'll try and really summarize it quickly. It's a question that I've been asked a lot. And just on a nutshell, I was born and raised in Israel, but my mom is an American citizen. She was born in Chicago, born and raised in Chicago, and she married my dad, and they moved to Israel, and I was born and raised in Israel. So back in the early 2000s, I actually immigrated to New Zealand with, back then, my girlfriend, now wife. And I really came to New Zealand as a fresh new start, to start a family in a neutral place. Israel was quite on a turmoil back in early 2000, a lot of suicide bombers, and not a great environment to bring up kids. We wanted to live in the country. We want to have some land, to have some space, and we went to visit New Zealand. And my wife's sister was actually already here, and we kind of liked the place. English speaking, prices were quite low of real estate here because back then it was still the end of the world. Now the market really compressed. The cap rates and returns have compressed because of the availability of people to travel quite fast, and being a safe haven, and being kind of a landlocked, really. In effect, New Zealand is basically a combination of 2 islands. The main cities in New Zealand in which I've been investing are kind of peninsula / landlocked geographically cities, and a lot of the immigration moved to those big cities, so the demand is very high. The market matured to be markets like LA, San Francisco, Seattle, Boston, very low cap rates. Lucky enough, I got in the, when I started, so I managed to build some asset base here in New Zealand. I'm currently in New Zealand, and have significant appreciation. But moving forward and adding to my portfolio and wanting to grow my cash flow was challenging because the yields are too low. So as an American citizen, about 4 years ago, I decided to look further afield and really do some market research in America. I traveled over and I looked into a few markets, got myself educated, and started small. Got my feet wet. Wanted to make sure that the team I built or engaged with on the ground in my market was going to be able to perform. So I started kind of relatively small, and gradually expanded my network and my acquisition. But I just want to mention, I did start in New Zealand. I caught the bug of real estate through the early 2000s. The market of globally was really taking off. Before the global financial crisis was a great year, 2003 until 2006. And I started as a wholesaler. So I assigned contract, I flipped houses, I did contemporaneous closing, built up some deposit and started buying my buy and hold. And that's how I kind of propelled it into larger asset as the time went by.
How was the New Zealand real estate market affected in like the financial crisis? Did they have very similar to, was there foreclosures and all that kind of stuff similar to the US, or was it a different story?
It was a different story. New Zealand is relatively small market,
right?
But in effect, the majority of the pain that was more of a pain of businesses where the funding were not able to renew, or some finance companies were going kaput and going bust, which would in effect made them illiquid. So what happened in New Zealand? There are 4 or 5 main banks. They are all owned by Australia. And there were, back then, as you know, in the US, there was no, also in New Zealand, there was no or low doc loans, meaning if you can fog a mirror, you don't have to prove your income as much, and you can get your borrowing. So that was the same case in New Zealand, but there's a lot of finance companies. So finance companies, the like of those small finance company that perhaps give deposits, but then they go and lend it, and they're able to lend you money on a high interest rate. They charge some fees. And there's a lot of business done with them, and then they're gone bust in the GFC, and that in effect created pain for some people who owned real estate because they were perhaps borrowing money from them to fund their businesses, or even some real estate. So only those people suffered. But as a whole, the prices went down by anything from 10 to 15%. It wasn't really a big deal. Yeah. So we were able to pick up some opportunities because of people who were in financial pain in the business, and they had to liquidate assets to pump the cash into the business. I had a couple of great deals that way, but there was not a lot of mortgagee sale. And there are rules in New Zealand as well, which are different to the US. You are unable to go, and if you're upside down on your mortgage, meaning you owe more than it's worth, you're unable to just leave your keys and declare yourself bankrupt, like people did in Nevada. I remember seeing it in Las Vegas. They left the keys and said, yeah. See you later. Goodbye. See you later. You can have the house. You can't do it in New Zealand, and not just only you can't. The lender are not allowed to throw you out, without going a whole process of really going through a process of foreclosure that way.
Interesting. Yeah, interesting the differences between countries. Obviously, we had a rude awakening here in the U.S. So you go from living in Israel to moving to New Zealand, doing real estate there. And you kind of ran into this, well, I'd like to keep on building my portfolio, but probably not going to happen here. So you have to explore elsewhere. How did you come about choosing a market in the US? It's funny because I just posted an article the other day on choosing a market and how you do that. And somebody responded and had a smart comment of basically, you can't go through the data points you're talking about and choose a market. It's just not possible. How did you go about choosing a market? I had to disagree with them, of course, because you and I know that we can.
Yes, you can, and I know that you're very astute, and there are metrics that you look at. If you want to buy asset that will generate cash flow, you're not going to go to Boston or LA, because it's just not going to happen unless you put 50% down or more, or you're going to be spinning your wheels for a long time to get the deal. So yeah. My first approach was to I was kind of talking to people in New Zealand that I know that was doing single houses in Memphis and in Jacksonville, Florida, and various other places. So I went there and I kind of got the feeling for the market. I checked the first thing I checked was the price to rent ratio. I want to make sure that it's cash flow. So I'm not looking to buy assets in markets that the price to rent ratio did not stack up from a cash flow point of view as a whole. The only market I did travel, which had quite a compressed cap rates comparing to back then Jacksonville or Memphis or parts of Arkansas, was actually Salt Lake City, which is a great market, had a tremendous growth and tremendous opportunity because it was landlocked as well. So there's always an opportunity in the market which is landlocked, and there is population and job growth. But the horse is bolted. There was no more opportunities for me that felt to get in. So then we started looking at things like job growth and population growth. I don't necessarily look to something which is a 5% year on year or something which is extraordinary for most market, but I'm quite okay with steady economy, a steady as she goes market, which had a proof record of maybe not going up and maybe not going down significantly in an up and down market. So that was quite important criteria for me. I usually want to see job growth of minimum 2% on 2 years, consecutive years. So I kind of like to see that as a good base. I like to have a diversified economy, of course. We'd like to see the number of employers, perhaps some large employers moving in, whether they're big box or whether they are now things like logistics and expanding of medical and expanding of various other sectors that add to the local economy. One of the ways that we do that is we actually contact the Chamber of Commerce. We engage with them. We ask them, where is the path of progress? Do you know of any new businesses that are expanding or coming into town, or perhaps opening shop or opening a distribution center or anything like that? Back then, I looked on unemployment rates. I really like to see, back then, up to before the COVID, the unemployment rate almost nationwide was hovering around, as you know, 3 to 3.6%. Yeah. And that was a really good nationwide. So, but as a whole, my idea was anything below 5% will be something to really look into. Back in 2010, though, in the really kind of when we were still in the global financial crisis, the average unemployment rate was about 9 to 9.9%. So that's but again, it's a recession. And I think now in most market we are still hovering around 6, even higher in some markets.
Yep.
The lowest unemployment rates in the US that I kind of researched was about 1.2% unemployment in the 1944s. So that's just something that I researched, and I took note of that because it's interesting to look at. Perhaps all the baby boomers wave starting to come out, and people are excited towards the end of the World War II and all of that. Another thing that we look at is, of course, median income. So I like to see a median income of about 50K per household income minimum. I like to really see a specific price per home. So house prices will be in my kind of desire area around $120,000 at least. That creates, if you like, a situation that some people will be able to buy a house, but there's going to be a lot of people who are going to choose to rent long term, in opposed to being able to afford to buy a house. In saying that, Todd, we are in a very low environment interest rate, and I do have quite a few friends in the States who are doing single housing, and as I'm sure you know that the housing market now, the single family houses is going crazy. There's so much demand, the inventory is low, and things are turning over really, really quick, and actually predicted to stay like that for at least 2 or 3 years moving forward. But still, we're seeing relatively good demand for our assets where we are at. We got not a lot of delinquencies right now. We had some tenants that needed some help and some, kind of concessions to payment plans and that, but we're relatively good. And I think it comes down a lot to where we are located, where our assets located, and how we actually do the tenant selection. So the majority of our residents, they are actually employed in works that are maybe a little bit more essential. And not just that, we did kind of an analytic with a property management company, and a lot of them have good money habits. A lot of them are 650 credit scores and upwards, which is kind of something that we find out that was worked to our benefit, dealing with people who care about the credit score, care about managing their their financials and all of that.
Yeah, there's a big difference from people who actually care about their credit score and those who don't. And
Yes.
that makes a world of difference. I like some of the stuff you said. Well, everything you said, I definitely agree with. One of the things that you said that resonates with me is a lot of people want to look for these markets or get excited about these markets that are seeing massive growth. And that's exciting. I get it. But usually with massive growth comes that time of bust as well. And so I'm with you there, where I like to see those markets that just have slow, steady growth. I want to see that, 1%, 2% growth. Then that's it. Population growth, job growth. We don't want to see, I should say we don't want to see, but, we're not looking for that 5, 6, 7% growth. And same thing with rent growth. Some people get really excited when their market's at the top of the rent growth. Well, what that usually means is, first of all, it's probably too late. Like you gotta, if you're looking at that and you're deciding that's your market for you, you're probably in it too late. You should have already been in it for 5 years prior to it. And now you're benefiting from that. But the chances of that actually going the opposite way and flipping is pretty good. And I saw that locally in my market. We're a slow, steady market. We typically don't see massive rent growth. And we saw a couple of years where it was 5, 6% rent growth. And that's really big for our market. And now just this last year, we saw 10% rent decline. And that just happens. So,
wow.
Hey, real quick, I just want to let you know about the multifamily challenge that we got going on. It's a 5-day multifamily challenge on how to get an offer in quickly, right? So we're going to teach you in 5 days, 5 1-hour sessions. We're going to go through the steps in the process to get there. So go to mfichallenge.com, mfichallenge.com. You can sign up. It's free. If you want the VIP, there's a bunch of things that we'll give away too. You do have to pay for that, but hey, it's going to be well worth it. Again, you can get in for free. We're going to teach you how to get that offer across the table, get the LOI in, all the steps. So Ellis Hammond and Ellis was episode 316. Check out his episode. And we're going to be doing this next week. So sign up now at mfichallenge.com, mfichallenge.com, and get in there. We're doing it next week, and it's going to be awesome. So hope to see you there. So you came. You got boots on the ground. You flew over and you toured the markets. Why did you think that was important versus just, that's a long flight from New Zealand to the US.
Very long flight. It's 15 hours, just 14 hours, 15 hours, just a flight. And it's very expensive. But, when I do something, I grab the bull by the horn and I just go for it. I want to do it professionally, and I was, my family, my wife was supportive of me doing that and understanding the benefit, the long-term benefit that we need to grow the business. And I want to really generate this continue generating the passive income and grow that, so we can keep living the lifestyle by design that we choose to live. Visiting the market regularly is a very important step of that, because in the end of the day, when you're investing out of area, whether you are in the US or not, your boots on the ground, your management team, the people you can rely on to service you are very key members of your team and a very key element of your success. If your property management is crap, or if you're unable to, as an asset manager, if you're unable to handle some of the unit turns and acquisitions, if you like, independently, if you just want to be a turnkey investor and just buy assets from a turnkey company, or just rely on your property management to do the unit turns for you and all of that, you're going to pay a premium for that. So for me, the trip over was actually to go plant those seeds, grow the relationships, so I can actually run the business. I do use my property management to do some things because they can do it more affordably. For example, painting. They got a good painting crew, and they can go and turn in a unit fast and very efficiently. But a lot of the subcontractors, I stabilized those relationships. I basically made sure that I stayed for at least 2-3 weeks when I came over. And it's not just for the professionals to do with the unit turns and the management aspect. It's also to do with the fellow investors relationship. other investment opportunity that you want to be able to do some driving for dollars and identify assets that perhaps will be a good part of your portfolio if you can engage and try and contact the owners and perhaps talk about a potential sale. Contact relationship with lenders, very, very important. Number one or two important partners in any transaction, really. Yeah. I mean, you need those relationships, that you need them to come and help you when you find a deal, specifically if you find a value add deal, which is what we are focusing on. It could be some hairy deal. My latest deal from last year, which I just refinanced, it was 30% economic vacancy, 30% economic vacancy, and 25% below market rent. The entry cap rate was really low, and being an out of states investor, I got quite a little bit of pushbacks not from the lenders who I've been in relationship with and communicating with for maybe 3 years, but when they took it to the committee, they did not have enough confidence in that deal because I was out of area. Although I'm using an experienced third-party property management company, they kind of, two of them that said they're going to fund it, they pretty much walked out and said, hey, we couldn't get it passed through the committee. But luckily, one of the lenders, community banks, which I established relationship with, and I opened a bank account and I put a few $1,000s in, and I became a customer. That's how you do it. You have to go and do that and set yourself up. Once you choose the market, open a small bank account, put $5,000 or even $1,000, start even get a secured credit card, start paying for some online subscription so you can start building your track records with them. And they came to the table. So they gave me maybe loan with terms that weren't ideal, but I got the deal done. And now when I stabilized the asset and added $1 million worth of equity within 1 year, I was able to use that as a leverage with the other lender that declined me. And I went to them and say, hey, would you want to refinance it now? And they said yes. And one credit union gave me really good terms, and I was managed to pull 130% of my money. Nice. And now I'm kind of more stabilized in their mind. Yeah. Because I've gone through the process, and if I wasn't traveling, I was trying to do it from remote control, I would not get that traction. And just to share, when I was there, I actually invited brokers that I communicate with to come and walk through the property, and I show them what we're doing and how we're repositioning. And also I did that with a couple of lenders, 3 lenders actually. I invited them to see how we are almost finishing the repositioning and how we took. And you have to be present. If you're not present, it's very hard to pick up momentum.
Yeah, you're coming here from a totally different country across the world, and you're doing stuff that people here just won't even spend the time to do. Spend some time with these brokers, show them what you're doing, spend some time with these lenders, get to know them, build a relationship with them, create an account, get the deposits. I mean, just, going out of your way to make sure you're building these relationships with subcontractors, with property managers and brokers and so on. You're doing those things, you're seeing the success. And so many people would have, again, that are just like local here, would have just given up. So a lender said, look, you don't have experience. I don't like what's going on here. We're not going to lend. You'd be like, oh man, I'm not going to be able to get this loan. This deal's dead. So many people would do that, but you didn't give up. You pushed on, you figured out a different avenue to go down, and you're able to make it happen. And that's so valuable for people to understand that, look, you're going to get rejected, and it'll come in different ways, but you're going to get rejected, and you got to figure out how to make it work, right? You got to figure out how to push forward. And it ended up being a success story in the end. You refinanced, you got 130% of your capital back out. I mean, shoot, even if you got your just a good refinance, I mean, just but you ended up getting some capital back as well. I mean, so that just shows the power of perseverance, right? And being able to push through in this thing, in this, and kudos to you for that. What's obviously that's a huge success habit of yours. What are some other success kind of habits or tips you can give us?
first of all, I would just like to quickly touch on what you said. I agree 100%. I think that comes the point when your education is high enough for you to really pull the plunge and get it going and start doing what you need to do. But the mindset, constantly working on the mindset, is very, very, very important. And being in real estate, even being as a almost 20 years ago as a wholesaler, I used to have big breaks before drinks. Frustrated, you can't get any deal. I've been self-employed for nearly 20 years. And I remember having months which I only made, sometimes nothing. So being persevere and persistent and positive thinking and working on your well-being is very, very important. It's as important, if not more than anything else, because and again, surrounding yourself with the like-minded people is important. Another thing which perhaps contributed, of course, it's my morning routines, which I do, which is to do with well-being, whether it's meditation. I like running. I really enjoy doing that, meditation every morning and running when I can, and I enjoy really working on my well-being. One thing that I can share is that scheduling my time and being able to really be focused on the key elements that will take my business to the next level, or that requires to do for achieving my goals. So what we do is basically, also in the MIH Mastermind, we set up quarterly action plans. So we have 3 focus areas which we choose that will require you to implement and achieve that will take you towards achieving your yearly goal, if you like. So we do it every quarter. And under the 3 quarter areas, we actually list the steps that we require towards achieving those 3 focus areas, and knock them down. So, for example, your focus area 1 would be, if you're starting out, choose a market. Number 2 will be develop a broker conversation system, relationship, if you like, to pick up some momentum in that market. A third one, for example, will be to generate deal flow. So how are you going to do it? You're going to do a direct mail marketing, you're going to do cold calling, are you going to do text messaging? What are you going to do? So writing those things down and really having a plan and a daily planner that you write things down, what you need to do on a daily basis, is very, very important. Whether you have it on your phone, on your calendar, or anywhere that really keeps you accountable, and write it down and make it happen. Another thing that helped me a lot to scale my business is hiring a virtual assistant. In the beginning, I hired to do some admin work, which I wasn't enjoying to do. So I kind of thought, hey, this is taking too much of my time. I need to call those brokers, but I also need to do this. And if I can delegate the low level activities to the virtual assistant for $5.75 per hour, I'm much better off doing that. Once I started implementing that, suddenly the floodgates have opened, and I'm actually able to delegate to her much more things that I initially even planned to, which it's even simple things, which reviewing the property management statements that they send monthly and cross-check their expenses, or cross-checks the KPI, the key performance indicators. Make sure that you send me a report every month where we are at with this, and many, many, many other things. So working in your business on the items or the activities that are most important, the most valuable, if you like, to your business is something that I've been focusing on. What we call the A-level activities in opposed to the D-level activities, which is admin. It's not adding enough value, and you're not enjoying it. Yeah. You want to do what you enjoy.
Yeah, absolutely. It's so important. And you're going to have to go through that all the time. It's not like it doesn't just, you don't go through it once, then it stops, right? Because we always seem to find other stuff to fill our day with. So you're going to have to, like, for me, I just have to like cleanse and go through it, once every, probably I do it probably twice a year. I just kind of go through and go, okay, what else can I get rid of? What did I start taking on that I shouldn't be taking on? So yeah, super, super valuable. What's Go
My
ahead.
latest thing, Todd, just yesterday is I'm sending my accountant the books now in bits and pieces, and
Yeah.
then he came back to me and he say, hey, what this, what that, what this, and it's all kind of coded. And yesterday I got around to figuring that out and itemizing line items of all those expenses. I never even planned to do it, but I just didn't want to do it. And instead of me spending 2 hours trying to break my head to figure it out, she's in the Philippines. She's a little bit younger than me, quite a bit younger than me, probably half my age at least. She got it to me within half a day.
Yeah.
And I'm so grateful to be able to have that, which I didn't need to have a brain damage trying to figure it out. If somebody is hiring a VA and they're happy with her, there's one tip I can give: treat them well, give them a bonus by the end of the year, because if they're good and they're reliable, you want to keep them. And that's what we did. I gave her 2 months bonus, and she was really stoked, for Christmas. And it's very important because they are very valuable for us.
Yep. And you're not paying them a lot of money. It's a lot of money for them, but you're not paying them a lot of money. And a bonus that doesn't seem that big for you, it can be very big for them. So yeah, I agree. What's a mistake that you've made along the way, and how can others here learn from it?
Okay, so there are potentially, over the years, few mistakes, but one of the biggest mistake that I would say is overcapitalizing on a deal. So when you buy an asset and whether you there's no emotion involved. Generally speaking, there is no emotion involved. I looked at the numbers and I move on. I had a couple of deals that didn't go well, and one of them was a can of worms. So basically, we had to keep pumping money into the deal, and basically to get it to a position that if we sell it, it will be something that it's worth selling. And more often than not, in those two deals, we had to spend more money than we actually planned to. And we in one of them we broke even, and one of them I lost about $30,000. No big deal, but it is. But it's a learning curve. So when you go into a deal, whether you fix and flip or whether you're buying an apartment community or 10 unit, 20 unit, 100 unit, you don't want to spend more than what you need to spend to receive the NOI or the return on investment that you're actually planning to achieve. And one of the ways to do it is to really consult with your property manager, or really consult, if you're flipping, perhaps consult with your realtor who will sell your asset for you, an appraiser or anything like that. So overcapitalizing, it's a big thing that people have to watch, because every money that you spend more than what you actually plan to or need to, you're taking down from your bottom line. Very important.
Yeah. And so you're saying over improving, doing way too much on the property.
Yes.
Yeah. Definitely, and easy to do, right? Because you go, well, I'd like to have this, and we want to make this better. So it's easy to do. It's easy to overcapitalize. It's easy to under as well. I mean, some people want to be so cheap, they don't want to do anything. I think one of a mistake that I made early on, and I can remember this specifically, is my very first rental property. I put in the cheapest stuff possible because I didn't have any money. I didn't. And so I did everything as cheap as I possibly could. And I found that we had to be there all the time doing repairs and maintenance. And I was doing the repairs and maintenance a lot of times myself, or I would send people, but it's costing me so much money on that. I realized very quickly that we have to also make things quality,
Especially if you keep it long term, you're better off spending a bit more, so it's more robust, or it's a long term, less maintenance ongoing. One more thing that you have to really keep in mind when you are looking into buying real estate: never be a motivated buyer.
Yeah,
I've done it. I was in 2015. I had I was looking for a development site. I wanted to buy a site with a buddy of mine, and develop three townhouses. The market was very strong, and we had no deals for a long time. So we found this deal that was touch and go if it's actually going to work or not. And we entered the deal, we got the deal, and the margin was quite a bit skinnier than what we wanted to, but we went in. And with ground up construction, things could actually go wrong. And if they go wrong, it's typically a considerable amount of money.
Yeah.
So what happened was we needed to get a consent from the consent and agreement from the neighbor to that will allow us to have to shift the stormwater to the boundary, so and they can tap into it again. So they were tapping into it to drain the stormwater, but we needed to shift it because we didn't want to build over it, because that will mean bridging and it will be more costly. So the neighbor was very friendly in the beginning and said that he's going to do it. And at some point, he's suddenly gone blank on us. We didn't know if he wants like money, like, maybe we need to bribe him to get him to agree, or what the hell is going on. And it took us about 18 months to actually do it, for me being really, really, really persistent with him and not losing it and really cultivating the relationship. And in the end, we had to give him, I think, $2,500 or something to agree. But I waited for the right timing. He wanted to move up some statues in his garden, and he had to get a little truck with a high hub crane at the back to go over the fence and lift those statues, very heavy statues or something. So I used that opportunity. I told him, "Hey neighbor, you know what? We're more than happy to do it for you, but we need you to sign the dotted line." And he did. And the moral of it is that, we were anxious to get into a deal. There was not enough margin. There's not enough room for era contingency, if you like, to allow for an extended holding cost or a shift in the market. Also, that happened in that particular deal. The New Zealand government introduced a loan-to-value restriction. So when we wanted to sell, we actually decided not to pursue with it because the neighbor was a pain, and we said, let's just sell it with a permit, with the building consent to go and build those 3 townhouses to another developer. But the New Zealand government introduced a loan-to-value restriction, which suddenly any property which is not your residential home, you'll have to have only 60% loan-to-value. So suddenly the market of pool of buyers has really shrank, because to do a development of, let's say, $2 million, $2.5 million, suddenly they need more money to get in. So that shifted the market, and I ended up losing $30,000. But I learned so much. The one thing that I learned was, don't be in a hurry to get into a deal. Don't be a motivated buyer, because you're going to end up doing a mistake. Rather be patient than not. And number 2, actually, that period of time in my life was very stressful. I was really stressed because I had a HELOC over my home, and I used $500,000 to put into this deal. And at some point, when the neighbor went dark on us, I just didn't know whenever is it going to end. I was like, what? So I took debt over my house, and I'm paying interest. And all that. So I was really getting quite stressful time of my life. But it was a pivot time of my life as well. That's the pivot of time of my life, which I'm grateful for it, is when I started meditating and really caring about my well-being more intensively and more on a regular basis. So everything that happened to you in your life, look at the bright side, and it could be a blessing in the sky.
Yeah. Well, and that can't be more accurate. Every challenge is an opportunity for improvement. Every challenge is an opportunity to discover something about yourself or your business, or learn how to improve. So absolutely. We're going to have to wrap up here. What's a favorite book that you can recommend to our listeners?
Well, I read a lot of books. I kind of try and, I'm not a fast reader, but I read, a few books a year. I just go from one to the other. I can recommend 2 books. I can recommend 3 books. One book is Build a Business, Not a Job, by David Finkel from Maui Mastermind. Mm-hmm. And that's a great book that helped me a lot to scale my business in terms of creating systems and getting to actually understand that you want to be working on your business, it's not in your business. It's quite a good, easy, practical book, number 1. Number 2, The Slight Edge by Jeff Olson, great mindset book. really, really good book in terms of really doing those little actions, things that will really make a difference and propel your life to the next level. And of course, perhaps the compound effect by, I think it's Darren Hardy, which is things takes time to see the progress, but if you keep doing it, if you're doing it the right way, it will compound and you'll get the result that you want. As the saying goes, if you keep doing the same things that you've been doing, you'll get the same results. If you want to take your life and you want to take your business to the next level, you need to start doing things differently so you can get different, better results.
Yeah, absolutely. Yeah. Great books. Last question. What are your 3 pillars of wealth creation?
3 pillars of wealth creation.
Yes.
Tell you what, I actually got the 5 elements of business success. So I'm going to run through them quickly because that's really what I practice. One of them is number 1, focus. Try and stay focused, avoid the shiny object syndrome, and become an expert in your field. Know your market well, know your niche. Number 1. Number 2, have a measurable action plan. And I'm a great believer of a vision board as well. I got a vision board here in my office. I got one in the bedroom. I like to visualize where I'm going, what's my why, what is my driving force behind me, and kind of a broad look of not just business, also well-being and family and stuff like that. Number 3, proper time management. Very, very important. We talked about that. Number 4, understanding your finances. Not just, you don't have to be an accountant or a CPA or anything like that, but you should know what you can afford to buy. How are you going to action, transaction if you need to, whether you're going to use your 401k, EQOP, retirement plan, what you're going to do. You need to get clarity about that, whether you need to raise money, partner with people, get clarity where you're at. And number 5 is accountability. Accountability is very, very important. A lot of people start the journey. They even go for some coaching or they go to, a couple of seminars, but they got no accountability to actually keep pushing them. And the accountability is very important, whether it's a coach or whether it's your business partner or your wife. Very, very, very important. The saying, accountability is the glue that ties commitments to results. And that's just, we have to do. Accountability is the glue that ties commitments to result. Very, very important. And those are my 5 elements. So these are my core focus things that I keep in mind for business. Yeah,
man, I love them. Focus, measurable action plan, time management, understanding finances, and accountability. Great things. Well, look, Hadar, really appreciate you joining us, taking time out of your day, and tons of value you're able to give. How can our listeners get in touch with you, learn more about what you got going on?
Sure. Just visit me on the mihmastermind.com website, mihmastermind.com. Or you can call me if you like, or text me on my mobile. It's a US number. It's a 501-251-8201. And look forward to chatting with anybody who wants to chat and discuss markets, real estate, multifamily. Always happy to connect.
Awesome. Well, again, appreciate it. And you have a fantastic rest of the day.
Thank you, Todd. Thank you very much.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out. And we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.